a professional student, part of the topics we need to deal with under equity finance is what we know as efficient market hypothesis. So when I'm talking of efficient market hypothesis, which is known as EMH, is the investment term in the investment community, and is one of the underlying reasons investors may choose a passive investing strategy. Although the fans of index fund may not know this. Efficient market hypothesis helps to explain the valid rationale of buying these passive mutual funds and exchange traded funds. And we are talking of efficient market hypothesis. Efficient market hypothesis essentially says that all known information about the securities, such as stock, is already factored in the price of those securities. Efficient means that information is what? Is free flow, and everything has been factored into the stock price. So whatever things you think is going on in the market has already been incorporated in the price of those securities. Therefore, assuming this is true, no amount of analysis can give an investor an edge over other investors, collectively known as what? As the market. Efficient market hypothesis does not require that investors be rational. It does not require that investors be rational. It says that individual investors must act randomly. Being rational is different from being random. It's not expected everybody to be rational, but they need to act randomly. But as a whole, the market is always right. In a simple term, efficient means what? It means normal. Efficient means normal. For example, an unusual reaction to unusual information is normal. And if a crowd suddenly starts running in one direction, it is normal for you to run in that direction as well, even there is not a rational reason for doing so. So everybody is going the same place. And we have a form of efficient market hypothesis. When I'm talking of these forms of efficient market hypothesis, we have the weak form hypothesis or efficient market hypothesis. And this weak form efficient hypothesis suggests that all the past information is priced into securities. All past information is priced into securities. So the fundamental analysis of securities can provide an investor with information to produce returns above the market average in the short term, but there are no patterns that exist. Therefore, fundamental analysis do not provide long-term advantage, and technical analysis will not work. That is about weak form hypothesis. As I said, it suggests that all past information is priced into security. So fundamental analysis of security can provide an investor with information to produce returns above market averages in short term, but there are no patterns that exist. That's on that. And the second form is semi-strong form hypothesis. What this implies is that neither fundamental analysis nor technical analysis can provide an advantage for an investor, and that new information is instantly priced into security. That is under semi-strong form. Once the information comes out, it is quickly priced into security. Anytime information comes out, it's quickly priced into security. And the last one is what? Strong form hypothesis. And this says that all information, both public and private, is priced into security, and no investor can gain advantage over the market as a whole. Strong form hypothesis does not mean some investors or money managers are incapable of capturing abnormally high returns, because there are always outliers included in the averages. So that is different types of hypotheses we have. And this concept does not say that no investor can outperform the market. Let's get it right. Efficient market approach does not say no investor can outperform the market. What it says is that there are outliers that can beat the market averages. However, there are also outliers that can dramatically lose to the market. So the majority is closer to the median. There is no win, or there are those that win and are lucky, and there are those that are lose that we say they are unlucky. That is on that. The next thing we want to look at is how passive and active investors look at efficient market hypothesis. We have active traders and we have passive traders. Let's look at how passive and active investors look at efficient market hypothesis. What we want you to understand here is that proponents of this hypothesis, even in its weak form, often invest in index fund or certain exchange traded fund because they are passively managed, and these funds simply attempt to match and not beat the overall market. So index investor may say that they are adhering to the common sense. If you can't beat them, join them. If you can't beat them, join them. Instead of trying to beat the market, they will buy an index fund that invests in the same security as the underlying bench industry. So some investors will try to beat the market averages, believing that the movement of stock price can be predicted at least some degree. For this reason, efficient market hypothesis does not align with the technical trading or technical trading strategy. So this is because technical traders study short-term trend and pattern and attempt to detect buy and selling opportunity based upon these patterns. Traders who definitely reject the stronger, that is, trader will generally reject the strong form hypothesis. The strong form hypothesis that nobody can outperform the market, but there are some people that have insider information that usually outperform the market. And for more on this hypothesis, including arguments against it, there are a lot of things that people have said regarding it. We have some people that always outperform the market, and then we have some people that always want to stay with the market. It depends on the perspective at which individual is looking at this concept, which we term efficient market hypothesis.